Hi everybody, welcome to this month's tax tips. We've had an autumn statement now, so there's been yet more changes to the tax system, and so once again we're going to have a look through the latest changes. The biggest change most recently announced was to the Research and Development Tax Relief Scheme. I know a number of our clients benefit from this scheme, and up until recently, where they have qualifying research and development expenditure, the R&D tax relief scheme allows that expenditure to be enhanced by 130%. Well, from the 6th of April 2023, the scheme is not going to be as generous anymore for small and medium-sized businesses. And rather than 130%, the uplift is going to be reduced to 86%. To quantify that, that means if you spend £100,000 on research and development, then you'll only get an additional £86,000 added to your profits for corporation tax purposes, rather than the previous £130,000. And with corporation tax rates set to go up to 25% from the 1st of April 2023, that's going to reduce the research and development corporation tax saving by £11,000 on a £100,000 spend. The other aspect of the research and development tax relief scheme is that if you make a loss after accounting for your enhanced research and development expenditure, then you can claim a repayable tax credit from HMRC. And at the moment, you can surrender your loss for a tax credit of 14.5%. Well, that tax credit is going to be reduced to 10% from the 6th of April. So on a £100,000 loss, that'll reduce your tax rebate by just over £4,000. So again, big changes to the tax system, and for any businesses that are relatively reliant on tax credits because they're in the early phase of developing products that they're going to bring to market, and they're using the R&D system for cash flow purposes, this is going to be quite an important change, and they'll need to forecast that into their cash flows and make sure that this doesn't cause too much of a significant detriment to the work that they're doing. The other changes have come again to income tax. From 6th of April 2023, the additional change that's been announced compared to all the other ones we've talked through already is that the rate, the threshold at which the top rate of income tax is paid is going to be reduced from £150,000 to £125,000. For small business owners, there is also a change to the dividend allowance. At the moment, the first £2,000 of dividends payable tax-free. From 6th of April 2023, that's going to reduce to £1,000. And from the 6th of April 2024, that dividend allowance is going to reduce from £1,000 to £500. So a relatively small change for small business owners, but just another example of how we're all going to be paying more income tax going forwards. A number of people have said, what does this actually mean in terms of cost to me? So I've set out 3 scenarios just to have a quick run through to try and give you an idea of the monetary impact of all the income tax changes that we're facing since Jeremy Hunt became Chancellor. First of all, my first example is for 2 business owners, husband and wife, £50,000 of earnings each. They take a small salary and they take the rest of the remuneration as dividends in a fairly standard way. The current, I've said current income tax liability, that refers to the 2021-22 tax year. That's obviously technically the last income tax year, but you will be paying that income tax liability on the 31st of January coming in 2023. That income tax liability, effectively the old tax rates, is £5,314 between the two, the husband and the wife. That's based on the old rates, as I say, 7.5% basic rates of dividend tax. The projection now for the income tax liability next year, for the year ended 5th of April 2024, will be £6,375. That's absolutely no change to the amount each of them draw out of the business. It just reflects the increase to income tax rates and the reduction to the dividend tax allowance. My next example is higher rate business owners. So again, husband and wife, earnings of £100,000 each. Their current income tax liability, again, 2021-22 tax year, so payable this January, it's £37,609. And their projected liability going forwards, that's going to be jumping up to £39,990. Again, they haven't done anything in terms of increasing their drawings. They're just going to be paying more tax. The third scenario is someone or a couple who earn £150,000 each. Their current income tax liability, £81,327. And that is going to increase, as you can see, significantly more to £87,704. So the biggest change is for these top earners. And that big increase is the result of the higher rate threshold reducing from £150,000 down to £125,000. So suddenly, in this couple, they've got £25,000 of earnings each that have gone from being taxed at the higher rate of tax to the top rate of tax. And that's quite a big jump for them. And one thing you might have noticed as we've gone through these slides as well is that as your earnings increase, your tax liability increases disproportionately. So as you double your earnings, you don't double your tax bill, it goes up significantly more than that. Moving on to this month's quick tax tip. Well, as we've seen, income tax rates now are definitely going to go up going forwards. And so if you were planning to pay yourself a bonus or withdraw surplus funds from the business, then now is the time to do it, because income tax rates are just on an upward trajectory. This income tax year, you will pay less income tax than you will next year. As you saw in scenario 3, from 6th of April 2023, people earning now above £125,000 will pay significantly more income tax. And so if you're looking to get, like I say, cash reserves out of the business, now is the time to do so.